Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Europe podcast. Good morning. It's Wednesday, the 13th of August. I'm Stephen Carroll in London. Coming up today, global stocks have hit a record high as US inflation data fuels bets on interest rate cuts from the Federal Reserve. Donald Trump tells the CEO of Goldman Sachs to stick to spinning records and take a beat on the bank's negative tariff forecasts. Plus, charged up while getting paid to buy, store and sell energy back into power grids could be the next big trade. Let's start with a roundup of our top stories. Global stocks have climbed to a record high after the latest US inflation data eased price concerns and strengthened bets on a Federal Reserve interest rate cut next month. The MSCI All Country World Index hit an all-time peak following Wall Street's surge as money markets nearly fully priced in a 25 basis point reduction at the Fed's next meeting. While core US inflation accelerated to its fastest pace since the start of the year, a modest rise in goods prices has tempered fears that the cost of tariffs could push up prices more broadly. Jay Barry is JP Morgan's head of global rate strategy.
I think there is some encouragement from the fact that you didn't see any pickup in core goods pricing so far, where it's another month with the tariffs in place where you haven't seen them pick up. That has given market participants a bit more sort of lack of concern right there. And you pivot it back to the labor market after today, that if we know the Fed has an asymmetric reaction function and seems to be more concerned about labor market weakness than inflation being above its target, and with the slowing we've seen in private payroll growth, it kind of gives the green light to go back and think about the Fed cutting in September, even with inflation very far away from the Fed's target.
Jay Barry speaking as investor focus now shifts to Friday's US retail sales figures for signs that consumers are as upbeat as recent corporate earnings commentary has suggested. Donald Trump has criticised the chief executive of Goldman Sachs, saying that David Solomon's bank made a bad prediction about the impact of the US president's sweeping tariff agenda. Bloomberg's Ewan Potts has more.
Donald Trump says the boss of Goldman Sachs should maybe just focus on being a DJ, referring to David Solomon's part-time hobby. The US president also recommended the bank get itself a new economist, saying on social media that Goldman Sachs had made a, quote, bad prediction on tariffs. Trump didn't specify why he was upset, but his remarks follow a weekend research note from Goldman that said the impact of tariffs on consumer prices was just starting to be felt. In London, I'm Ewan Potts, Bloomberg Radio.
The US President's pick to lead the Bureau of Labour Statistics, E.J. Anthony, has suggested suspending the agency's monthly jobs report. Speaking to Fox Business on Monday before his nomination, Anthony suggested switching to quarterly reporting until issues are resolved. White House Press Secretary Caroline Leavitt says she expects the monthly reports to continue.
He floated the idea of possibly suspending until they can get the data and the methodology in order. And this president wants to ensure that the BLS, again, is putting out accurate and honest data that the American people can trust.
White House spokesperson Caroline Leavitt was speaking as critics have warned that eliminating monthly jobs reports could undermine public trust and hurt financial markets that rely on timely employment data. Meanwhile, Britain's struggling statistics authority faces a 6% real terms funding cut by 2029. The budget squeeze at the Office for National Statistics comes as it tries to recover from a data crisis. Bloomberg's James Wilcock has more.
Delayed releases and major mistakes in GDP, jobs and inflation reports. Many have asked how the Office for National Statistics fell into crisis. Poor management and the social impact of COVID, even the new popularity of Ring doorbells have all been given as answers. But you can't rule out money. The body that gathers UK data has suffered under austerity. Our reporting suggests it will now have to turn around its service while facing more real terms cuts. In London, James Wilcock, Bloomberg Radio.
We're turning to Ukraine's president, who says he won't give up control of the eastern Donbass region to Russia. Volodymyr Zelensky was speaking as he pushes for his representatives to be included in planned talks between the US and Russia on Friday in Alaska.
It's impossible to talk about Ukraine without Ukraine, and no one will accept that. But they cannot agree on anything about Ukraine without us. I truly believe and hope that the US president understands and realises that.
President Zelensky speaking there through a translator. In order to unlock a ceasefire and broader peace negotiations, Russia's President Vladimir Putin is demanding that Ukraine give up the Donetsk and Luhansk regions. Doing so would grant Moscow a victory its army has failed to achieve militarily for more than a decade. And Germany's Conservative alliance is losing ground to the country's far right. That's as the Chancellor's own popularity also deteriorates. Bloomberg's Tiwa Adebayo has more.
Support for Germany's right-wing AfD party is at a record high according to new voter polling figures. The jump comes just 3 months after Chancellor Friedrich Merz and his ruling coalition took power. Merz's personal favourability has also suffered, with the leader's approval rating sinking to its lowest level since stepping into office. Voters are unconvinced that the German premier is making noticeable improvements compared to the previous government, according to Forza, the pollster behind the figures. Their latest survey says only 29% of voters polled in early August said they were satisfied with Merz's performance, down from a high of 43% in June. In London, Tiwa Adebayo, Bloomberg Radio.
And those are your top stories on the markets. The MSCI Asia Pacific Index 1.1% higher. Eurostoxx 50 futures are up by 0.4%. The 10-year Treasury yield just easing a basis point now to 4.28% as we have the euro trading a tenth stronger against the dollar at 116.85. In a moment, more on how markets are ramping up bets on a rate cut from the Federal Reserve next month, plus why the next big energy trade is mega batteries for Europe. But another story that I've been reading this morning, the latest in the Travel Hacks series from Bloomberg Pursuits. Mark Elwood's been speaking to the cocktail guru Colin Asare-Appiah, who regularly travels more than 200,000 miles a year, so has something to say about ways to make travel easier. Now, Colin was born in Ghana, grew up in London, now lives in New York City, so even that gives him a fairly broad range to be covering. But the conversation that he had with Mark yields some gems, including that he has a handy guide on the essential cocktail kit to bring with you when you travel. Essentially, a tiny bottle of bitters, he says, is the key to making a cocktail on the go if you're in a hotel with, a kettle and potentially getting a slice of lime from the bar there as well. That sounds like too much hard work, though. He's also got tips for the best bars in Johannesburg, Cape Town, the cocktail festival you won't want to miss, and even where to get a martini in London. His tip, Ago Peroni at the Connaught Hotel. So you can read the full piece on Bloomberg.com, and we'll put a link to it in our podcast show notes as well. And let's turn back to the markets now, where a global benchmark of stocks has hit a record high as traders are now pricing in a 25 basis point cut from the Federal Reserve next month. Our executive editor for Asia Markets, Paul Dobson, joins us now for more. Paul, the move in rate cut pricing came after the inflation data yesterday, which gave us further insight into how tariffs are affecting consumer prices. What exactly did we learn that caused markets to move?
Yeah, good morning, Stephen. So, looking at it from afar, it might be a little bit of a confusing picture to see inflation rising, getting to the fastest rate since January, but at the same time seeing Treasury yields fall and people betting that the Federal Reserve will move closer to cutting interest rates. But what's really going on here is people were focused very clearly on goods prices and how much of the US tariff costs are being passed through into that bucket in particular. And they concluded that there was no reason for panic. There was no sign that the tariffs were having a particularly inflationary impact based on the data that were there. And therefore, they were confident that that would give the Fed enough leeway to cut interest rates by paying attention to the weakening job data and focusing a little bit less on the inflation side. Now, there's plenty of worrywarts out there who are saying this is the Fed tacitly kind of abandoning its 2% target rate, saying it's willing to protect or accept these higher costs, not worried about it. This is an abomination. Some people are pretty outraged by it. But on the other hand, the market loves the idea that the Fed is going to make interest rates a little bit lower, borrowing costs lower. And that's why we saw those equities propelling to new record highs.
Well, just talk us through how this story is playing out in Asia today, because it had sparked a rally on Wall Street yesterday, but that's continuing into what we're seeing on markets today.
That's right. And I think, as well as the equities rally, you've got this sense of calm over markets now that we have a little bit more predictability there. So you have the VIX, which measures US stock market volatility at the lowest level since Christmas last year. You've got the MOVE index of bond volatility, the lowest since 2022. And even FX volatility is now the lowest since this time last year, more or less. And so everything is pointing to calmer markets. And Asia loves that. Asia loves reduced volatility, and it likes a weaker dollar as well. Lower interest rates pull down the dollar, buoy Asian currencies and buoy Asian markets in general. So you've got stock gains pretty much across the board. We've got some record highs in Japan, in Taiwan. We've got the Shanghai Composite at its highest level since 2021, I think it is, and so on and so forth, pretty much across the board. Indonesia may be getting to a record high sometime soon as well. So Asia's celebrating, in short.
Yeah, the party continues, but thinking about where the Fed might go in September has been the focus of this. The US Treasury Secretary Scott Bessent suggesting the Fed should be open to a 50 basis point cut at its next meeting. What's the likelihood of that?
The likelihood is pretty low, given particularly, we had a split Fed vote already, and some of the policymakers that we're hearing from are still pointing to the idea that they would rather wait than act now. On the other hand, the market is starting to price in just that little bit of a possibility of a greater cut. September is 90% priced for a 25 basis point cut. So the general consensus is that that's where they will go. But some of the options market plays that we're seeing starting to emerge, people betting on a more aggressive start to the cutting or restart to the cutting cycle, just like we saw with the Fed when it began to ease interest rates again in 2024.
And Paul, just a brief word on this question about the monthly jobs report. We've been talking a lot about the reliability of data on today's show, but this question now that E.J. Anthony raised before he was nominated to be head of the BLS, that maybe the BLS should switch to quarterly jobs reports instead of monthly ones, how would that go down with markets?
I think that would get a unanimous thumbs down. The payrolls report, more than anything else, is the barometer of US economic strength that the market uses to try to anticipate what the Federal Reserve is going to do each meeting. So disappearing that data or putting it on hold or making it less frequent and less regular would certainly be treated with a certain amount of disappointment and dismay by the markets, who would rather have more reliable and frequent data rather than more opaque and less frequent data. So hopefully, when we prefer transparency too, we prefer reliable data, makes our jobs as journalists easier as much as anything else. Hopefully that's just a suggestion, just a floating of the idea. And what we'll actually see is the US government providing more funding for that department and therefore helping to make that data more reliable and more timely.
Okay, Paul Dobson, our Executive Editor for Asia Markets, thank you very much. Next, to what is becoming the next big energy trade in Europe. As renewable energy output soars across the continent, investments in battery storage have struggled to keep up. It's driven commodity traders to get involved, and our reporter Archie Hunter joins me now for more on the story. Archie, good morning. What's sparked this interest then in batteries for traders?
It's something that commodity traders have done for decades and further back. If you think about it as buying a resource, storing it, and selling it at a point where demand is higher and prices go higher or supply is lower. In Europe, that's happening more and more and more with electricity prices or power prices as renewable energy sources come online and drive electricity supply massively during the day and much less during the evening when demand also picks up. So there's a lot of volatility in the prices, and that's really what brings traders to the party.
So who's investing in this, and what sort of investments are they making?
Some of the companies are doing it in slightly different ways. So Castleton Commodities, which is a trading company, is buying battery, I guess you'd call them sort of battery farms, where, they'll get into a development, they'll say they get the approvals to build huge amounts of these, like, I guess they look like sort of big white boxes. They're putting them all over Europe in places where renewables are the heaviest, so where the grid is really in need of balancing, mostly. Trafigura and Vitol are also doing the same thing through joint venture companies.
What does a massive ramp up in battery investment mean then in terms of what we can think in the moves in power prices? You talked about the massive volatility that's existed in electricity spot prices from the increased use of renewables. As people ramp up batteries, does that mean essentially that might start to smooth out?
I think the idea is that you have batteries that can store power when there's an overload in the market and distribute it when there's high demand and less availability. So theoretically, this is something that Europe is going to need masses of to level out this shift, which we've already started to see, but is only going to increase to renewable power generation.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.